Looking to buy or sell real estate out here in Oahu? Well, in this video, we're going to go over the market update and show you not only the macro, but the micro data and my predictions of what I foresee happening in the near future in the Oahu real estate market. Stick around to get all the details. See you on the other side. Today, we are going to be doing a market update. We've been seeing some subtle changes happening. I'm going to go over a bunch of different data that's going to help us get an idea of our predictions for the future of the market. But before we jump into that, let me quickly introduce myself. If this is your first time here, my name is Patrick Lally. I'm a licensed real estate agent out here in Hawaii and have been for nearly a decade, helping buyers, sellers, and investors with their real estate needs. If you have any questions or simply want to talk real estate, I've got my contact information right here, or you can directly DM me on any of my social media platforms. With that being said, let's jump into the data and understand what is going on in the real estate market. Okay, so now when it comes to making our predictions, looking into our glass ball and trying to figure out what is going to happen with the economy, but more importantly, real estate prices, we have to look at a handful of things. And I've done this in a lot of my past reports, but we want to look at what's the main thing that's really important to the Fed, who's controlling interest rates. That is going to be inflation. And then secondarily would be the jobs. They want to make sure that there is not a huge amount or increase in unemployment, because that would trigger a recession, which would trigger them to have to drop rates significantly, print a bunch of money, and then put us right back to where we were when we had hyperinflation. That's the main thing they want to avoid, is trying to find this happy median where, hey, let's get a hold of inflation, but let's not crash and burn the economy. So that's kind of where we are right now. As you can see from the peak of 9.1, we've seen the bottom flat out at 3%. Their goal is 2%. Not sure if we're going to get there anytime soon. It could take some time, but I think we've gotten to a point where they're thinking to themselves, okay, we successfully dropped inflation, but we don't want to do anything radical that's going to make everybody lose their jobs, and then put us in the position where we have to drop rates. We want to drop rates because it's time to, not because we have to. So we can see we've been bouncing back and forth anywhere between 3%, 3.7 at its highest, and it's gotten, now we're at 3.5 in 3.4 in April of 2024. So we were kind of doing this bouncing back and forth. We can also see, if we look at the labor market, we have seen some more jobs coming to the market, but not a slew. We can see here that the April jobs report had the economy adding 175,000 jobs, but that's below expectations of the downshift from the blockbuster hiring in March that we had of 315,000 jobs. Now, I believe that this data lags. So, I've been hearing through the grapevine, people having challenges finding a job, people losing their jobs in certain industries. And I think it's going to take time, as it takes companies time to fire and to hire, for that data to come out. I think that we're going to see in the next report that maybe jobs isn't as attractive as it has been in the past. And it's going to slowly start to push the Fed to potentially drop rates. I would say realistically, probably at the end of the year. I don't think it's going to happen anytime soon. But that's kind of what we're tracking here. Now we can look at this tool called the CME Fed Watch tool. Now this is a great tool that kind of lets us see what the sentiment is. Now we are currently at 525 to 550 basis points. And we can see that the sentiment right now is that the next meeting, June 12th, is that there's a 96.2% chance that they're going to stay exactly at 525 to 550 where we are currently. Now, as we go further down the line, we can see that that sentiment starts to shift a little bit. We can see that there's a 78% chance that they're going to stay still in July. And in September, we can see that it starts to be a 50% chance that they might drop at a quarter point. This will change as data comes out. I think realistically, we probably won't see rates start to drop till November or December, where we can see that there's a higher chance of even more rate cuts. But I don't think they're going to do 2 basis points or 50 basis points. I think they're going to slowly do a quarter point, then they'll stand still, see what that does to the market, maybe another quarter point a few months after that. So I don't think we'll see significant changes till, realistically, I think September at the earliest, at the latest December or January. And as you see, as we go further down, we can see that the chances of rates even going significantly lower than that start to increase. So I don't think, the common theme that's been going on is higher for longer, and I do believe that. But I do think we're going to see some subtle cuts happening so that we can have that soft landing that the Fed is shooting for. Now, when it comes to the microeconomics, or more specifically, the real estate pricing and how this is translated in the data here, we're going to look at two markets. That's going to be the condo and the single family home market. So if we look at this on a rolling 3 months, we can see that when it comes to median sales price, we can see that the bottom, as it always has been, was in February of 2023. We've already started to recover, and we can see that it's basically kind of floating in this area, similar to the inflation report, where we're kind of bouncing up and back and kind of in this purgatory area. We don't see the market shooting off. We don't see the market dropping significantly. We just see it kind of in a balanced market. We are seeing some new listings coming to the market, though. We are starting to see inventory get unlocked. We can see homes for sales are increasing as well, which is going to increase most likely the amount of closed sales. So we can see the closed sales are starting to increase as well. Now, what is ironic, because when you see that more inventory coming to the market, is you would naturally think that prices would go down. But what we're seeing happening here is the days on market is decreasing slightly, which means homes are selling, and they're selling in a reasonable time frame. But I believe that we are seeing supply increase. If rates don't come down soon, we will get a lot more inventory coming to the market, which should dictate prices coming down slightly. But I think it's pretty much just going to stay balanced, as we've kind of seen here. It kind of just staying in this place. I don't think it's going to shoot up. I don't think it's going to shoot down. I think it's going to stay kind of still in this little area here until rates come down. And that's for the single condo market. Now, for the single family home market, we can see here that it's starting to do something similar as well. It's starting to flatten out. Now, we had our peak here in May. We had our bottom there in February, similar to the condo market. And the bottom was at $1 million for the median sales price for a single family home. And now we're at $1,070,000. Now, if we look at it month to month, we can see that that has dropped just slightly to $1,052,000, which would be in line with us seeing new listings ticking up, homes for sale starting to flatten out a little bit. And if we look at days on market, we can see the days on market has dropped down significantly from 29 days to 17 days. So again, it's a mixed bag of data. But if we look at it accordingly, we can see that homes are selling faster than they were a couple months ago. We are seeing new inventory coming to the market, which I think is going to somewhat balance it out a bit, so that we're not going to see prices skyrocket. I think we're once again going to see it kind of float in this area until rates come down. So we're in this purgatory time. I think there is opportunities. Me personally, I'm utilizing this time with understanding what I think is going to happen with rates, is to get a good deal, leverage a 2-in-1 buy down to get into the deal and lower your rate through a 2-in-1 buy down, and then plan to refinance once the Fed gets their stuff together and starts dropping rates, as we can see here. Could be significant within the next year or two. So that's my strategy. I'm doing that personally on the home that I'm purchasing right now, and I'm suggesting that for a lot of my clients. But that's kind of what we're seeing happening in the market. So as you guys just saw in that data, there is some subtle changes happening. The Fed, I believe, is really just digging in to say that, hey, we're going to hold rates. I don't believe they're going to go up. I don't think they can afford to do that. I think it would just create a massive recession and lots of job loss, which then would force them to have to drop rates, print money, and put us right back into the inflationary or hyperinflation area that we were in post-COVID. So I don't think they're going to do that. I think they're going to stay still with rates for the next couple months and slowly trickle down and bring rates down to have that soft landing that they're shooting for. Now, if you are a buyer and you're looking to purchase a property and you're waiting for rates to come down, you definitely can do that. But I do think that there's an opportunity right now where you can get a property, as we're seeing more inventory come to the market, and you can negotiate the price down or negotiate credit to do what I would suggest, which is a 2-in-1 buy down. I have a video right here that goes over how that works, but generally that would give you enough time to wait for the Fed, as we saw in the data, to get their stuff together, drop rates, and then refinance when that happens. So that's what I would suggest. Now, if you're a seller, you of course can sell now. I think more inventory is going to be coming to the market as rates come down, where I think we're in this purgatory area where you still will sell your property in a reasonable time frame as long as it's priced right, but we're not in this crazy booming market that we were in post-COVID. We're in more of a balanced market. So you could wait for rates to come down, but we also may see more inventory come to the market. So it's a tough one to say. But that pretty much wraps it up. If you guys have any questions or got any value out of this video, do me a huge favor, smash that like button as well as click the subscribe and notification bell so you get notified whenever I drop videos just like this. And if you have any questions, reach out to me. I got my contact information right here, or you can directly DM me on any of my social media platforms. I'm Patrick with PatrickLongleyRealty.com, powered by eXp Realty. Hope you have a beautiful day. I'll talk to you soon. Aloha.